So this week we had a kind of a big event. Fannie Mae decided to charge more on loans despite market conditions. Fannie Mae decided to charge more, and they were calling it an adverse market fee. So I'll let that go. But what we think it is just money grabs, because a lot of banks out there are not lowering the rates to the level that the bonds are trading at. So basically lenders are keeping that money. We're guessing that Fannie Mae said, hey, if you're keeping that money, you're going to hand it over to us. But what ends up happening is the banks pass that fee on to the consumer. And so the consumer still is not getting the discount. In fact, Fannie Mae caused a raise hike. So rates did not go up this week because of the market conditions, but because Fannie Mae added in a new LLPA to their pricing. If you remember, we talked about LLPAs before. So for example, why does a condo buyer pay a higher interest rate than a house buyer? Why does an investment property have a higher interest rate than an owner-occupied property? Why does someone with a 640 credit score get a higher interest rate than someone with a 740 credit score? Well, all those things are drivers for Fannie Mae to have these add-ons that they call LLPAs, and that's a loan level pricing adjustment. And so what that is there's a baseline interest rate, and then Fannie Mae adds for the risk that's involved in those extra things like a condo versus a house. Like their data shows that more condo buyers foreclose than house buyers. There's more risk also because the HOA could be mismanaged. There's a lot of reasons condos carry more risk than single family homes, single family dwellings. And same thing with investors. An investor, they would think that the cash flow of a property makes it a less risky loan, but their data shows that fourplexes foreclose at a greater rate, or the people who are supposed to pay the mortgage on the fourplex, but that property type tends to carry a higher foreclosure rate than, say, a duplex or a single family home. So these LLPAs are built-in pricing for taking risk, right? So anyway, so what happened is Wednesday night, all of a sudden, after hours, after markets are closed, they announced that they were going to add a 0.5 or 0.5% loan level pricing adjustment that they were calling adverse market, bad market fee. So, and why they need that fee when in actuality servicers are paying the mortgages on forbearance loans. So it's the servicers that are bearing the brunt of the liability for this, but for some reason Fannie Mae added this on. Maybe they're foretelling the future, I don't know. But 0.5 point, for example, if you're borrowing $4,000, 0.5 point is $2,000. Most people don't want to pay that $2,000. Most of the people who are refinancing with me right now are wanting 0 points and 0 cost loans. So they definitely don't want to all of a sudden be told, oh, now it's costing you $2,000 more to borrow that money. So what ends up happening is they want to build it into the rate. They want a 0 points loan. So let's say Wednesday morning, I could have gotten a 0 points loan at 2.875, 30-year fixed, right? Friday morning, that same 0 points loan was 3.125. So that 0.5% LLPA, in essence, is about 0.25% more in interest rate, which if you were to calculate over the years, 0.5% is probably $30,000, depending on the loan amount. You're paying more over those 30 years. Now, most people don't keep their loan 30 years, but that's the equivalent. So it's really not fun. There's a lot of pushback, a lot of industry associations, mortgage associations, realtor associations. So a lot of groups did a lot of pushback Thursday before this went into effect Friday. So we'll see if they maybe take that back or reverse it, or maybe even postpone it. They've been known to do that. So I had a flurry of activity on Thursday trying to lock people in before this happened, because I knew it would be about 0.25% interest rate hike in one day, which is a lot, although rates are historically low. And the 3.1250 points is what we were offering back in April. So rates had slid down mid-July down to that below 3%. So in essence, we're back to where we were. But it's just a bummer when the markets are not improving. The bond market is not improving. And so it's a bummer that the consumer ends up paying more a higher rate. So just to give you an example, the Fannie Mae 30-year bond is trading at 2.5, yet the clients are getting 3.1. Okay, so that's it for our little lesson on how Fannie Mae can affect our Fannie Mae and Freddie Mac, I should say, can affect our interest rates despite market conditions.